We've got Vodafone Idea down 2%. We've got, I'm picking up the big ones here. We've got Punjab National Bank where the quarterly update has come out, that's down 2%. We've got HDFC Bank where the quarterly update is awaited, but that's not going anywhere. Now specifically Lemon Tree yesterday clocked extraordinary volumes, and today also it has already seen volumes of 1.3 million shares. For a sector which everyone had written off that will never make a comeback, now some of these stocks are commanding valuations and commanding interest, which is absolutely amazing. Adani group of companies, well, the Supreme Court reserve judgment should be pronounced today. Ahead of that, Adani Enterprises is up, Adani Wilmar is up, and Adani Port is trading with a positive bias.
Yeah, all of the Adani Group entities are holding up a buzz. The hearing will begin, of course, at 10:30 a.m. We will be tracking that closely. Coal India, the non-regulated sector supplies till December FY24 was at an all-time high. So Coal India, of course, is one stock which is in focus. There's RVNL as well. They've got the joint venture has got an LOA worth about 123 odd crore rupees for a station upgrade. So look out for that stock. And how can we not talk about VST Industries? That's the one stock which is in focus. Radhakishan Damani acquiring 2.22 lakh shares via a block deal, 4.25% of a gap up is what you're seeing on VST as we speak right now. There's also Avenue Supermart, and it's a soft quarter 3 update that they've actually handed out. Let's see whether there's any weakness in the stock. Sure enough, down about 1.5% as we speak on that stock. Having said that, the quarterly update from Yes Bank is pretty positive. They've seen a growth of about 13.25% on their deposits, CASA ratio at 29.6%. Versus a comparable of 29.9. Moil record production in the month of December. It's an uptick of about 31% in terms of tonnage. Shyam Metallics, the buzz in the market is that there's going to be a QIP and a sizable one at that, almost 1,400 odd crore rupees. So the stock starts off absolutely flat as we speak right now. There's Strides Pharma as well. Amansa Holdings has been a buyer yesterday in a block deal of 1.35%. That stock holding higher by about 2.6% right now.
Let's now say hello and good morning and even Happy New Year to Sridhar Sivaram. Good morning.
Good morning and Happy New Year.
Why are you looking different?
Sorry?
Why are you looking different?
I'm different. This is a new year, so a different look.
Will it be a different look for the market also this year?
I hope not. Market's been doing very well. So the same look is good enough.
So you expect the kind of returns what we've seen, how much of that will continue? How much of 2023 returns are likely to roll over to 2024?
If I had known all that, I wouldn't be sitting here. I'll be sitting in some, luxurious island.
You've been
And
going
you're not
there,
going to
no?
say island, you have to say a resort or safari.
Jungle.
But you go there, right?
So yeah,
So, yeah, obviously
I'll
you know that's why you go
permanently be
there.
I'll permanently be there. Jokes apart, I think India will do well. I think the stars are aligned. If I look at emerging markets and see how they have performed, within that only 2 countries have given 8% plus dollar returns in the last 10 years, which is India and Taiwan. The rest all have been a basket case. I have been saying that emerging market as an asset class is struggling because they haven't given any returns for say 10 years, 15 years, 20 years. And every year we see the same thing, one country disappointing versus the other, and India stood out there. I don't see that changing. And I think barring say, in the short term you can say the market's overdone, a little bit of correction. But over a medium to long term, I would say that India will continue to give the return. So if you say 10 years or 20-year returns, they are in the between 12 to 14% range. I don't see any reason why that should change over the next 10 to 20 years.
Are there clusters of overvaluation in the markets?
Of course.
PSUs, small caps, what's happening in the SME space, or even the IPO flurry that we've seen?
Yeah. So we remain quite bullish on PSUs.
Sure.
In fact, especially the banks. So we did a quick number crunching to figure out what has happened. These stocks have gone up so much. How have the earnings grown? Surprisingly, the earnings in the last 3 years have outpaced the stock returns. So actually, they've got derated.
Earnings have outpaced the stock return.
Yeah.
Okay.
So actually, they've got derated because the stocks haven't kept pace with the earnings. And if I look at the earnings outlook from here on, also. I think they will do north of say 30%.
You're talking about which category of PSU? Because it's metals.
PSBs.
No, I'm talking of the banks. Yeah.
Okay.
within the PSUs in general, there are various pockets.
Yeah.
Okay, so some pockets like defense and all have become very expensive. There are other pockets like say the oil marketing companies, if you take, they look extremely cheap, but they are cheap for a reason.
Yeah.
So if you want to, fast forward and assume that some of these will change, then they are interesting bets. So there are various pockets which have different valuations. We remain bullish on the entire pack selectively. Banks surely, and others selectively where we think that earnings look good, opportunity is decent, and valuation comfort is far better than other pockets, as you
Sure.
mentioned in the
So,
market.
other than PSBs, where do you find in this market there's value on the table?
So I would say in some pharma companies where some cases we are seeing some corporate action where the companies are divesting their some businesses, some companies are merging with the others. Domestic business in some cases are undervalued, so we do see some opportunity there. Large cap financials look very good. They haven't done anything in the last year. Maybe for the right reason, because liability costs were going up. So market was smart enough early enough to understand that liability costs will continue to move up. We think that that looks quite interesting. So that's the other pocket, I would say. Otherwise, it is mostly stock specific in most other places.
And
What
what other stocks you like? Since it's stock specific, I'll be simple here.
Unfortunately, I can't speak on stocks, but yeah, you.
You like gold though, and the mantra for 2024 is
Well, I've been-
diversify your portfolio,
I have been
right?
speaking about gold for a very long time,
Yeah.
and my point is simple that if you take gold returns, because gold is a hedge against the currency, so people underestimate the currency aspect of gold. Our currency has depreciated 4-5% every year. You take the 20-year returns, gold and Sensex have given same returns, 13%. And you take the last 5 years, also the same returns. So, yeah, there'll be pockets where the markets will outperform gold or gold outperforms market. My point is that you have options like SGB, which is a financial gold, which you can invest, gives you a tax-free return, plus it gives you 2.5% interest. If you add up all of that, it actually gives you a return better than the markets. I'm not suggesting you don't invest in markets. I'm just saying 5 to 10%, depending on your appetite, you should invest in gold. And I always say that Indian woman has been the best fund manager. We do so much analysis and we struggle to beat the returns that the Indian woman makes by buying gold. That's the reality of life.
Yeah, and I don't know what the Indian woman is doing when it comes to buying household items with inflation, etc.
But you are a man, you're buying gold, ऐसा नहीं है.
Huh?
You're a man, you're buying gold, ऐसा नहीं है.
But I am buying gold only in
On
the
the
last,
behest of-
say,
yeah.
7, 8 years or 10 years. Indian women is buying gold for 50 years.
Yeah.
Yeah.
Fair point, fair point.
But consumption, some updates coming in, the slowdown seems to be a
Yeah.
bit evident within that space. Is that a
Yeah,
concern?
so I've traveled a lot in the last 2 months, been to at least 4 or 5 different states in the remote places, and I can say that it's clearly a K-shaped recovery. There is stress in rural areas, and hopefully this, as we come closer to elections, we see an increased spending across the board, and maybe that brings a cheer and the consumption starts to boom there. But I would say that we currently are in that K-shaped recovery. Anything which is urban related, and we are seeing the numbers also, they're all doing well. Discretionary consumption, if it is urban, be it hotels, airlines, airports, you just go, you know what is happening there.
Yeah.
But as you move into the hinterland, things are a bit slower, I would say. So that's how I would categorize how things are right now, and hopefully this changes in 6 months.
There are 3 big assumptions for 2024. One,
Yes.
FIs will come and they will come back and they will be forced to buy into Indian stocks. They will keep on bidding the prices higher. Assumption number 2, continuity of the government, and that template, what has worked so far, will continue to roll after May 2024 also. And the third assumption is that earnings will continue to compound anywhere between 12 to 14% or 12 to 15% depending on the estimate. Which assumption out of the 3 assumptions, these are popular assumptions, consensus assumptions, could be challenged?
One.
FIs will
That
not come
FIs
back?
will not come back?
No, so when I speak to all my friends who run FI money, one, as I said, I think emerging market as an asset class is getting challenged. If it hasn't given returns for 20 years, I don't see any reason why this will change in the next 4-5 years. People are already questioning this asset class. One of the simple reasons why I've been talking about that this asset class is getting challenged is the fact that this is not a homogeneous asset class. It has countries which have current account surplus and countries which have current account deficit. Countries with 30,000 per capita to 2,000 per capita, and commodity exporting countries to commodity importing countries. So the plus of one is minus of the other. Net for 20 years we've not given any returns. Within that, India has done well. So various emerging market fund managers now trying different types of emerging markets, say emerging market ex China or Asia ex China. But I don't think lot of pension funds or large funds will want to invest in some of these type of funds. Some of my friends who run India dedicated FII money are saying that they are not getting incremental flows. They are getting very trickles, not to the extent that they would have expected. And most fund managers are overweight India. Massively.
Financials.
Massively overweight India. Because China has done nothing. So if you take last 3 years, I'm saying MSCI dollar return, China is down 20%, India is up 10%, CAGR. So in 3 years, India has outperformed by 30% CAGR over China. India's weight has gone from something like 10% to 18% in MSCI. So yeah, on that 18%, most funds are already overweight. So I don't think FIIs will make such a massive difference to the market. I think the domestic flows will continue to surprise. FIIs will at best may not sell, but keep in mind that China has become so cheap that if it turns from here, there'll be a lot of people.
Yeah.
I mean, actually the positioning is really bad for China right now. I don't know much about China, but I just know that the positioning is very bad, right? Consensus underweight, India is a consensus overweight, and they haven't been cheaper. And some of my friends explained to me stories in China. I said, wow, I mean, these stories are available at 3p, 4p, 50%
and it's
cash.
pretty much back to normal. I mean, I know people who travel to China.
So I
It's
think the
business
only
as
problem
usual.
with China has been that they haven't had earnings growth.
Perception.
Perception is one, but they also had earnings challenge, whereas India is surprised on earnings. So when you mentioned that what can be challenged, the third one also can be challenged to some extent, but our earnings trajectory has held very well.
If China comes back, we'll stay with this, then this entire excitement which is centered around manufacturing, China plus one, EMS. China is a ready supply chain. India is building a supply chain. If China comes back, exports will come back. The supply chains will be rolling. So then what happens to China plus one Indian manufacturing themes?
So China, it is not like China comes back. China is already open. But because of the geopolitical issues that China is having with the US, India is in a sweet spot. That's what I mentioned earlier, that the stars are aligned for India. So whether China comes back or not, the China plus one story for India remains. Actually, it has become plus one now, not just China, because there is also some European plus one that is happening on the chemical side. So I think that plus one story remains. We remain very constructive on the entire manufacturing, EMS, chemicals, because there may be some cyclical issues in a lot of these, but on a structural basis, we think this is a very bullish space. Just take Apple as an example. There are no listed plays for Apple manufacturing, but Apple wants to go from 10 billion exports to 100 billion in the next 2 to 3 years. And we know from speaking to supply chain people who are manufacturing, say some of the components, that they are the orders are like 10 times their current capacity. And they're scared. I mean, I put up this 10 times capacity, what happens if Apple doesn't come? So I think the opportunity space is huge. We will see manufacturing as the next big theme for India. Like what happened to auto ancillary? 20 years back, we were just an assembly unit in India. And today 97% or 95% is manufactured within India. Same, I mean, the skeptics say that, oh, this is just an assembly unit, not more than 10%. But that is changing. Maybe in the next 3 years, we go to 30% manufactured or value added in India. That's huge. And if one Apple does, the entire ecosystem gets built, it becomes a huge industry.
So before Avan and Asha take over, I have a follow-up question, which is that, okay, I completely, anybody is watching the show is perhaps convinced that, okay, what Suzuki's entry did to India, Apple's entry will do to the entire electronic manufacturing space. You know, Manish Bhai has been talking about this from last 6-8 months now. So if that thought has to be extended in terms of an actionable
Investment
process.
team,
Yes.
What is the best way to participate in the EMS scheme? There are 4-5 players who are listed.
See, I'll not
just buy
give
a
names,
basket,
but
just buy the basket.
Yeah, but I'm just saying this basket will do well.
Okay, even though it is
because
expensive.
it is not just mobile manufacturing; it is electronics. So you and me will know that in everything that we touch today, the electronics component has gone up 10 times. Even you take a EV has so much of electronic component. All of that has to be manufactured.
My coffee cup has an electronic sensor now. It checks the temperature.
Wow.
Everything has an
everything is
electronic
become
component. So
electronic.
it is not, so people confuse this by thinking that this is only a mobile or something like that. From a medical device to say an electronic device or some manufacturing automation that has happened, everything needs an electronic component. So EMS actually takes into account all of this. So they are basically suppliers for all of this. So it could be anything. Even a chemicals company needs an electronic component that also gets manufactured. So EMS as a space, whether it is +1 or not, is going to boom anyway because the electronic component in our daily lives is significantly going up. Now, having said that, these stocks have rallied a lot. So it is not as if they have not rallied. Their earnings will also grow. May not be structural, may not be like every quarter it grows. So you will see surprises here. Those are the opportunities to buy. That's how I would say that you have to look at it from a 3 to 4 year perspective. And if I look at which industry can do well, I think this industry stands out. They're not very high margin, so I will want to caveat. They're not very high margin business. They are
12-13% margin.
no, they'll be single digit. in
Dixon
most
and
cases.
others have even single digit.
So most of them will be single digit, but
Shirma
their
is double digit.
ROEs will be good because asset turns are good. So it's a different way of looking at it. We are always obsessed with high EBITDA margin companies, but I think markets recognize that this is how it is.
Sure. But tell me, if the FIR money weren't to come back to India, while we've managed to do it all by ourselves thanks to the DII flows all through 23, does the theory of bet on large caps also get challenged? Because one was betting on the FIR money finding its way into large caps.
Yeah, so I'm not saying that FIs will not come. I think given that emerging market is a large asset class, even though it's not still getting money, the other thing that is happening is that within emerging markets, given that fund managers are unable to outperform the emerging market benchmark, money is shifting from active to passive. So when you get active to passive shift, then people are buying, that money just goes into the index, which is large cap heavy. So it's also a question of how, so if you look at what has happened to passives in emerging markets, the chart is going like this and the actives are falling. So the overall pie is still remaining roughly the same, but passives are gaining, which augurs well for large cap. In general, I think even if you're active, the mid and small cap, I mean, I don't think FIs come in the small cap anyway. Even the mid caps, they look quite expensive, So I think the opportunity set
The
is
writing's
shrinking.
on the wall.
Yeah, exactly. I don't know when it happens, but I think if I were to take a bet, I think large caps should do well. Large caps did well last year, barring the top,
Selectively,
top 7, 8.
Yeah.
So if you take, the Nifty top 10 performers, all of them gave north of 30% returns. It's just that they weren't the top 7, 8 market cap large caps.
Yeah.
So.
And there's been so much activity in the primary markets. Aisha spoke about IPOs as
Yes.
well. Just your thoughts, because at the same time, within that space, it has been a bit of a wake-up call when it comes to profitability metrics, etc. for a lot of these.
Yeah, so this reminds me of late 21 when we had this frenzy of IPOs, and then 22 was a wake-up call, and people then started to change their business models, which is good. That's happening. This sort of reminds me again of the same frenzy that we are seeing. So whenever you see frenzy like this, you have to step back and assess the situation. We don't have any FOMO, we don't have any benchmark, so maybe we are in a better position than many of my other fund manager friends who have to manage daily NAVs and other things. So it's easy for me to say that you step away, but that's the reality. We
Okay,
can just
one
step
does the
away.
Google, we pretty much get the top holdings of Enam securities. Public information. I'm not getting into stock specific, just hear me out. The core of the portfolio is a mix of pharma, good old names like MRF, LMW, Wellspun, Zodiac. How much of your portfolio construct, given what the market levels are, given where the earning cycle is, could it change as if you
So
go
actually,
forward?
this gives you only where you have more than 1%
Yeah.
holding, and so it shows up all the mid caps. But given the size, it's predominantly large cap.
Okay.
So it's this doesn't reflect the true, holdings of the group.
My point is here, what I'm trying to understand is, as investors, you can always find opportunities and you can always find pockets where you think markets are running ahead of themselves, which means you need to book out profits or you need to ride the earning cycle. How much of the portfolio construct for the house which you represent could change given that the dynamics in the market are changing? For example, IT is slowing down. For example, chemical has gone through a big churn. For example, pharma is making a comeback. Are there large portfolio changes which could be on the anvil looking at either valuations or the earning picture?
A lot of the changes already happened. Like we would have definitely added more to financials, large cap financials.
Yeah,
I
yeah,
mean, PSU banks we've been adding over the last 2-3 years. I don't think that has changed much. We've in fact added more, in the last 6 months because that's a pocket where I see very strong earnings growth. So I think it's a constant process, but some of the strategic long-term mid caps that we own, I don't think we keep churning that. I mean, that's not the style. So that remains.
Are there any large changes which you think you could be doing, considering again valuations or where the sector is headed? I mean, a sector sometimes is called as a sunrise sector, a sector sometimes becomes a sunset sector. That's the nature of the sector, that's the nature of the earnings trajectory. Are there any large changes which
See, we have differences of opinion within the firm. Like
Okay.
I've been a bear on the IT sector for a very long time. And my point is that AI is disrupting Indian IT sector because 30% of the software industry's employees are in the 1 to 3 year experience base.
Yeah.
And if you see I just track one number for every result, which is what has been your employee addition
That's coming
or
down.
reduction. It is coming down. So it is telling me, because coding has become so easy, experts tell me that what 10 people used to do, now one person can do the same job much more efficiently in 1/10 the time. So I think this entire bottom of the IT pack, which is the 1 to 3 year experience, is slowly getting reduced. There is attrition anyway. So as the attrition is happening, you're not replacing with newer people. So this is both an opportunity and a threat. Companies who can disrupt themselves will see this as an opportunity. I think the threat comes first and the opportunity comes later. So I remain bearish, but not everybody in the firm has the same view.
fair point?
They're still cautiously optimistic, quote unquote. But anyway, great speaking with you. Thank you so
Thanks
much
a
for
lot. Thanks
taking
for
the time
inviting
out
me.
and
Yeah, thank
joining
you.
us today. Let's just revisit what the market then has settled in at, and we will shortly be joined by the coal secretary as well, getting a sense of what's been happening in the sector. Well, of course, the market has started off just mildly soft. We're largely just consolidating on the futures around the 2169 level, thereabouts. Adani Enterprises, that's your big mover today, 5% higher. There's L&T Finance holding up 5%. Adani Ports up 3% right now. There's Manappuram higher by nearly about 3%. And ABB as well, which is clocking up nearly 2% as we speak right now. It's actually metals which are on the back foot. So everything from a Nalco to a JSW to Hindalco, they're all the ones which are taking a beating. It's the Nifty Metal Index, which is one of the biggest laggards. Can we take it across now to the coal secretary? Let's welcome on board Amrit Lal Meena joining in on the show right now. Mr. Meena, great to have you today on ET Now. Thank you so much for taking the time out. Mr. Meena, higher production coupled with relatively stable power demand has clearly ensured improved coal stocks at thermal power plants of late. Is it fair to assume that the worst of coal deficit is behind us?
As of now, as of 31st of December, the total coal stock in the country is 94 million ton, which is 23% higher compared to the corresponding period of last year. As regards the coal availability on thermal power plant end is concerned, this is over 32 million ton, which is higher than last year, and with the current level of production and the transportation, we are quite optimistic that the coal stocks will further go up, and we will have adequate coal for the coming summer season.
Right, sir. So the last time we spoke to you, you did say that thermal power plants have been importing coal for blending to meet the rising demand. Has the reliance now on imported coal reduced now with improving coal inventory?
Yes. See, if we compare period from April to December, last year for the purpose of blending, country imported 26 million ton of the thermal coal, but this year the import has been only 17%. So definitely there is reduction in overall also. If we look at the premium on the auction of the coal in the market, compared to last year, the premium is much low this year, which indicates the overall higher availability of coal in the market.
Power Minister said that in the next 2 or 3 years, the import of thermal coal will be fully substituted by domestic thermal coal. Are you confident that it could actually happen, because the dependence on imported thermal coal has only increased in last couple of years?
We are fully confident. We have clear plan of action as to how the production has to be increased. You are aware that Coal India, Singareni Coal Company, Captive and Commercial, all of them are contributing as per their planned target. We have 1.25 billion ton production plan of Coal India Limited, and all of them are achieving production as per the targets. We are quite hopeful that by March 26, whatever coal is produced domestically, that type of coal will not be required to be imported. However, the high grade coal and the coking coal, which is required for various sectors like steel, others, that will continue to be imported. But as far as the grade of coal which is available in our country, our production base is increasing, our evacuation capacities have enhanced, and there are further plans. So we are quite hopeful that by March 26, the import of the thermal coal, the grade of coal which is available in our country, will be reduced to almost zero.
Coal demand trend been for power versus non-power sector?
Coal demand, as far as this year is concerned, the growth has been about 7% higher for the power sector, and as regards the NRS sector is concerned, we have supplied almost 30% higher compared to last year, and there is adequate availability as far as power is concerned. As far as the NRS sector is concerned, coal is being made available on long-term linkage basis, FSA basis, and every month the short-term spot auction is being carried out, and the premium rates are reasonably low compared to the last year.
So we believe that there are some challenges as well with regards to coal evacuation. Help us understand how the coal ministry is addressing these problems.
See, there is a coordination mechanism between Ministry of Coal, Power and Railways. There is interministerial committee and there is a system of subgroup. So on regular basis, all three stakeholders ministries sit together and decide the rake deployment plan. So this year the availability of rake has significantly gone up by about 11% compared to last year, and lot of new infrastructure projects for decongestion of the railway network have also been commissioned, and there are long term and short term plans. So now adequate augmentation of the coal evacuation infrastructure is being carried out, and generally availability of rakes and the faster movement of rake is visible. Resultantly, there is very higher evacuation of the coal possible.
Right, and Coal India is expected to benefit from both higher volumes and from the e-auction prices which will be firm over the medium term. Can you take us through the capex plans, expansion plans for Coal India, production targets as well?
Coal India is doing extremely well. You must have seen the market capitalization growth in last about a year plus, it has gone up by about 40%. As regards the production volume is concerned, Coal India is consistently showing excellent growth of over 11% compared to the last year. And as far as the capex is concerned, Coal India has achieved 84% of its target by December. Primarily, Coal India is investing onto the first mile connectivity projects for eco-friendly mechanized evacuation of coal from the mines to the loading point. Massive investment is going on environmental sustainability measures, which includes closure of the mines and lot of afforestation, creation of water bodies, eco parks, OB2 sand, etc. Various projects are under implementation. Coal India also have plans to construct the spur lines as and when required. CIL has committed about 20,000 crore plus of investment onto augmentation of railway infrastructure in association with the state governments and Ministry of Railway in all three major coal producing state of Chhattisgarh, Odisha and Jharkhand.
Okay. So how well is Coal India prepared to meet the coal demand? What is a medium term plan especially for Coal India?
See, Ministry of Coal is fully geared up to meet the immediate annual growth of the coal requirement and also the requirement for 2030 and 2047. As you are aware that Coal India Limited, all other subsidiaries and the captive and commercial, all of them are producing to full of their capacity. New mines are being opened. Capacity of existing mines is being enhanced, evacuation infrastructure is being augmented, and technology adoption is being carried out. Underground coal mining is being promoted. Resultantly, the coal sector is fully geared up to meet the energy security need of the country.
All right. Thank you so much for taking time out and giving us a sense as to how things are shaping up within the sector as a whole, as well as the outlook for Coal India. That's Mr. Amritlal Meena, the Coal Secretary, talking about his outlook, how they are prepared to meet the long-term and medium-term requirements for energy security needs, and that they are confident of substituting imported coal within the next 2 to 3 years. A quick check-in on the markets as well, and how are things trending after a pretty okay start. Well, we've declined even further now with a 0.5% cut, so 21,566 on the frontline index. The broader markets as well seem to be in a similar zone. You've got sectors like IT particularly seeing the pain, metals, PSC, autos as well not contributing. Barring energy and the FMCG basket, there's a lot of red on the screen, and some of the big losers include GSW Steel, Hindalco, Wipro, Infi, Tech Mahindra, TCS, as well as Coal India in trade. And within the broader markets as well, some of the drags in today's trading session include the likes of BHEL, Fortis Health, National Fertilizers, Tata Steel as well, which is down 2.5%, Cyient as well as Hindustan Copper. Adani group of stocks, by the way, has seen a very smart leg up. Adani Energy, Total Gas, Green and Enterprises as well as ports. The entire cluster is abuzz. Let's hear it out then from Ravi Dharamshi talking about sectors and stocks that he's bullish on.
Longer term, I don't think we should be, the interests are aligned of the government and the minority shareholders. But there are sectors where there is virtual monopoly, right? For example, defense. There are not too many companies that manufacture aircraft or helicopter or radars or those kind of things. There are only those few players. So there is a runway available to them. The private sector, by the time they come, it will be at least 5 years, if not 10 years from now. So there is a runway available for them. Clearly, those companies will do well. So instead of focusing on PSU versus non-PSU, I would say which are the businesses that excite me and which are the businesses that I want to own. Now, then I will see whether who owns that business and whether my interests and their interests are aligned or no. And in PSU, again, one more thing that we look for is there a right to win? Most of the PSUs don't have any right to win. What they need is a general bullishness in the economy for the stocks to do well, which is what they have been doing. The day there is going to be some kind of a dip in the economy or any kind of a challenge, that is where these companies will suddenly the men and the boys will get separated. And I honestly feel it was only for example, in the banking space, it was only a reversion to mean trade. They continue to remain Me Too players. There is no special. I mean, there could be one odd PSU bank that has the right to win because of the depth and the penetration that they have. But in general, and it is a stated intent of the government that eventually there will be only 5 or 6 PSU banks left in this country. So you definitely want to be very selective and picky about which are the companies that you associate with.
So between 2023 Jan and 2024 Jan, have your top 4-5 holdings remained the same?
Good question. I am not very sure, but I would say, yeah, at least there would be 1 or 2 new ones that I've entered, more because of price performance rather than because I've placed a new bet. Yeah, clearly the last 12 months, a lot of stocks have done very well, and that is the reason why some of the stocks have come into the top 4-5 holding. It's not that we placed a big bet on it, but we run a very concentrated portfolio, so tends to happen that one particular stock doing well can increase the, it becomes a larger portion of the portfolio.
There are 2 big changes you've done in your portfolio. If I just take the clock back, you took IT completely out. You took, for example, pharma out. You've reduced the holding. Are there any large changes which you propose now we could see going forward, which could be radical changes in your portfolios, purely based on the thought process change?
Yeah, no, so clearly, as I mentioned, that election is a big risk that we are carrying. For a lot of our portfolio companies are beneficiary of the government strategy, government action, and too much dependence on that can be a challenge this year. Again, as I said, the theoretical risk is that the government changes, but I don't think that's going to be actually the case. But if that was to pan out, then my portfolio is carrying a lot of risk, and I definitely don't want to incrementally. I don't want to increase that risk. I would want to reduce that risk going into the elections.
A lot of believers in IT are of the view that, look, AI is just a passing phase. Y2K happened, enterprise happened, but Infosys, TCS, Tech Mahindra, they still are like top of the league companies. Do you think the AI fear is real, or AI is actually an opportunity? It may not happen this year, but it could happen in FY25 or 26.
No, so I clearly feel over a longer term period, AI is more a productivity enhancement. But in the shorter run, clearly it will create challenges. You mentioned Y2K. Y2K was a tailwind. Y2K was not a challenge for the IT sector. But if you remember, during Y2K days, these companies used to grow at 60, 70, almost 100% also. Today, now these companies grow at 8, 10. In fact, they struggle to grow at 8, 10%. One, their size has changed. And second, the business has become commoditized. And AI will actually commoditize it even further. So, so there are 2 things that the IT companies are running at. There is this old legacy business which is rolling off, and then there is this new business which is the digitization, which is picking up. But there is the one that is rolling off faster than the one that is growing. So at an aggregate level, these companies are not able to grow beyond 8-10%. And we have seen some of the stalwarts this year give guidance of 1 to 3%, and then within that 1 to 3% also further narrow it down to towards 1% rather than towards 3%. I think that is splitting hair. The fact of the matter is these companies are now commoditized, matured in nature, and they have not reinvented themselves. So giving a 25-30 multiple to a 8-10% grower in a good cycle, I don't think is a very smart thing. So that does not excite us. There is no re-rating possibility over here. So I would wait for the valuations to become so attractive in this case, where some amount of revival in growth can also lead to re-rating, which is what happened post-COVID, right, in most of the IT companies. But I don't see that today, so that is not something that excites me. On the pharma side also, there are different buckets, but the oral solid US-focused generic business is not exciting. Over there, the negotiating power has shifted totally in favor of the buyers over there. The sellers in India are never going to make extraordinary profit. there will be one odd opportunity in complex molecule or one odd opportunity in biochemical drug.
Maybe
But
injectable does well.
yeah, so but those trends are also now, injectable trend for example is now probably reaching its peak. Now if you see, just take out and see the last 3 years announcement, every company is talking about getting into injectables. So there is going to be a supply, excess supply in that. And again, the same thing that happened in oral solid will play out in injectables also, where there are 15 suppliers and 3 buyers. So the profit pools are kind of shrinking, and these companies have also grown in size. So I would say that particular piece is not exciting. But there are again small niche opportunities which are coming up, whether it is CDMO, whether it is, there are fermentation based API is a small technology which is very different. The opportunity size is much smaller, but at the same time over here the negotiating power is actually in favor of the seller as compared to the buyer. So you have to find those profit pools which are more sustainable and can grow over a long period of time within pharma and healthcare, rather than brush everything with the same paint and say this is good or this is bad.
That's the market construct and how 2024 is likely to be, and the view coming in from Ravi Dharamshi. But let's focus on the Q3 updates which have been trickling in, and we've got Pralay Mandal, the MD and CEO at CSB Bank, joining in on the show right now. Pralay, hi, morning. Great to have you on the show, and here's wishing you a very happy new year from all of us here at ET Now, firstly.
Happy New Year to you also, Aisha, and all your viewers on ET Now. Thank you.
Right. Pralay, help us understand what the quarterly update is like, because from what I see, while your deposits have seen an uptick on a sequential basis, that's not the case with your CD ratio. That's seen a bit of a decline, right?
So, Aisha, I think that was a deliberate move because, as you know, that CD ratio is, with the kind of liquidity challenges which are there in the system, we consciously wanted to keep a check on the CD ratio because it had gone closer to 87-88%. So we wanted to bring it down a little bit purely from a risk management, liquidity risk management perspective. And that's one of the reasons where we ensured that our deposit growth sustains and we focused on deposits. And I think this trend will continue for a quarter or two more till we have abundant liquidity in the system.
Given that Reserve Bank of India wants banks to go easy on unsecured assets, especially personal loans, could that challenge your FY24 growth numbers?
Not for us, because that's somewhat of a systemic issue. For us, we have not really done too much of unsecured business either on the SME side as well as on the retail side. We had just started, but we have slowed down a little bit because we thought that let's not catch this cycle at this point of time. We have enough other businesses to focus on. So from that perspective, some of the franchise and the credit cards and some of the other businesses we are picking up through our partnerships which you have. But right now we are also going slow on the pure play unsecured personal loans.
Is unsecured, and what growth rate you think you will be able to maintain for FY25?
I think I have said that before that we should be able to do anywhere between 30 to 50% faster than the system. I think we should be able to sustain through the year. Maybe one quarter here and one quarter there can be a little different, but overall for the year, I think we should be able to grow around 50% faster than the system.
Highlight for us, what are the pockets where you've seen weak growth during the quarter?
Degrowth, you said?
Yeah, weak growth, yes.
Weak growth. For us, I think this quarter had been, we had been a little conscious on our credit growth because we wanted to understand where the liquidity ratios are, the CD ratios are, and deposits are not coming cheap anymore, as you know. So we wanted to ensure that we have the right balance between deposits and assets. So we had not a very aggressive quarter on the wholesale side. Some of the businesses also got a little postponed to the next quarter. And gold loan also has grown by around 23%, which is slightly slower than what we generally do, because what we did is, gold prices fluctuated and went up significantly. We didn't want to ride that wave of gold loan price at this point of time. So we were a little cautious on the gold loan side as well, but still we grew by around 23%. Retail has grown well, but that's on a very small base, and SME has done well for us as well. So overall, that is how it will sustain. Next quarter, I think we'll pick up the gold loan because gold loan prices have stabilized quite a bit now. I think going into next quarter, we will focus back on gold loan, wholesale, SME, and retail will sustain wherever it is, and hence we should be able to pick up the credit growth little better in the next quarter.
Target to achieve your 5% NIMS target for the full year?
Yeah, I'm still confident. Let's see. I mean, hopefully we should be able to manage that.
Okay, and can you tell us how you're progressing towards increasing your presence in the north and western region? Any targets that you have in terms of your branch expansion?
So we are adding around 100 odd branches every year. So out of that, roughly 50 to 60% we're adding in north and west. Rest of south also we are adding a lot in Tamil Nadu, Karnataka, Andhra, Telangana. But lot we are doing in Delhi, Punjab, Rajasthan, Uttar Pradesh, Maharashtra, Gujarat, Mumbai, Delhi, all these locations. So to that extent, I think, and we are taking a cluster and hub approach so that management is focused, so that we are not spread too thin, because as you know, 100 is not a large number, maybe for us, but from a distribution perspective, not a large number. So to that extent, we are using a strategic focus. The other big change we are doing on the branch side, on the distribution side, is we are saying that a lot of branches which are doing a lot of business in the gold loan, but they have potential of doing other branches. We are expanding those branches without adding the count of the branches. So we may take a first floor there, we can take a larger area there, and hence we are adding beyond gold in these branches. So effectively, those branches will become more productive from other products perspective. So that's the strategy and plan. We are started with 25 branches as a pilot project on this specific project which I talked about, and we will, if it's successful, next year we will go whole hog on that front.
Reserve Bank of India's proposed guidelines for small finance banks, strict guidelines on what the dividend payout ratio could be, strict guidelines. These are not guidelines, but this is like a paper right now up for discussion. What do you make of it?
I think it is small finance banks. I saw also yesterday something related to the foreign banks as well. So we are also going through it. It's too early to comment on that. But for us, I think our board will go through all this and decide what we need to do. We are a full service and a universal bank. So to that extent, we will be guided by the universal bank license. But broadly, I think there are measures which are being taken, regulators, what they think are prudent from a dividend payout perspective. So let's see how, when the final papers comes out, we'll see how it comes out, and then we can comment on that.
Just to wrap it up with one final point, if I look at 2021 and 22, there was a war of liabilities. Everybody wanted to acquire more CASA. 3 months ago, it appeared that that fight was over. And I also thought that the war of liability is over. But when we spoke to the State Bank of India chairman 2 days ago, and when I look at the deposit increases they've done in certain categories, look like the war is still on. So will 2024 be another year of war of liabilities which will impact banks and their NIMs going forward?
So, Nikunj, I completely agree with you that ultimately the core strength of a bank is the liability franchise. Rest actually are built on the back of the liability franchise. And hence, if you see the larger, stronger banks which had a sustainable growth decade after decade, always had a strong, sustainable liability franchise. And hence, it is and will always remain a strongest kind of a strength for a bank. And banks cannot depend on wholesale deposits or cannot depend on the kind of CDs and those kind of things or borrowings alone. So given that perspective, and in between what had happened is obviously the 10-year GSEC, both globally as well as India, was really coming, it was very easy, but now it had gone up. Now it has again sort of stable at a certain level, 3.928 US, and in India is around 7.2. So depends on what RBI also wants the liquidity to be in the system. It has broadly remained negative in the last quarter or more. So given all this perspective, I think everybody would like to have their dry powder for the growth for not only for Q4 but also for next year, because economy is giving credit growth opportunities without any doubt about it. As the capex cycle starts improving on the private side post elections and things like that, I think every bank would like to have a source of deposits which is sustainable and consistent. So to that extent, I have no doubt about it that deposits will remain a key focus and key strength for organizations. For us, of course, we are a smaller balance sheet. It's a different way to manage that, and we are managing that. We are building our CASA franchise. It will take some more time, and hence we have to deposit on deposits as well. We have an NRI book which is slightly large. So from that perspective, we have a little more focused approach. But for larger banks, they have no choice. They have to focus on deposits as a major strength for the next few years.
All right, thank you for taking time out and joining in. That's the management of CSB talking about how there has not been too much business for unsecured loans. Gold loans have been slightly lower than usual, but as of now, the dividend policy by the RBI, too early to comment. 413 on last count, that's where the stock is at. Tell you what, we've got lots lined up ahead. We'll be connecting with the management of Paras Defense. We've got Chartbusters, all that coming up after a very short break. And as we do that, ET Now and ET Now Swadesh, in line with helping Indians rise with India, have partnered with Sundaram Mutual to launch Nivesh Day. It's a campaign to help viewers build their personal finance portfolios via disciplined investing on the 5th of every month. So join us and find out how you can build your financial future.